In the alternate version of Quick Study 3-9, we're asked to prepare an adjusting entry. And to help with the debits and credits, it usually helps first to identify what category of adjusting entry this falls within. So let's start reading through here. Barga Company is going to purchase $26,000 of equipment on January 1st, 2016. The equipment is expected to last 5 years and be worth $3,200 at the end of that time. So before we read the rest, let's first identify what entry would be recorded on January 1st. Do we go ahead and debit something like equipment expense for $26,000? Well, that doesn't seem correct, does it? Because we said that we're expected to have this equipment around for 5 years, so we think we're going to have it for 5 years to help us earn revenue over that particular time frame. This has some future benefit, so we need to defer recognition of the expense. Hopefully that's a big hint as far as what category this falls within. This is a prepaid or deferred expense. We need to defer recognition of the expense until the time frame at which we actually are using it up. So initially we're going to record this as an asset. In particular, on January 1st, 2016, we would debit the equipment account. So this is very similar to supplies or prepaid rent or prepaid insurance, something that's going to benefit our future. We initially record it as an asset and then slowly expense it over time. Now, one thing that's a little bit different about plant assets or things like equipment or building or furniture or computers or vehicles, long-term assets that we use in order to either build our product, sell our product, those types of items, is the expense has a unique name and it's called depreciation expense. Now, with supplies and prepaid rent and prepaid insurance, it was fairly easy to figure out, over the life, how much expense do we record. Rent and insurance might be equal amounts over time, and supplies is just something we can go out and count. But how do we figure out the amount of depreciation expense or expense where we're supposed to record over the life for something like equipment? That's a little bit more unique to figure out. Now, when we get to a later chapter, chapter 8, and we focus a lot more on plant assets, we'll look at different philosophies of how to come up with that depreciation. So far in this chapter, we're going to stay pretty simple and just use straight line depreciation. It's the simplest and most common way to figure out depreciation. Now, I will note that they ask us to prepare the adjusting entry to record the first year of depreciation expense as of December 31st, 2016, and they're very kind that they go ahead and tell us directly the amount is $4,560. Unfortunately, your accounting instructors aren't going to necessarily always be that nice on the exams to tell you the amount of depreciation you're going to need to record that year. So you need to know how to calculate straight line depreciation. So make sure you can work through the calculations we'll do next. So straight line depreciation, the formula mentioned in your book, is cost minus salvage value. Salvage value is simply just what is the value of the item we expect at the end of its life. For example, this equipment, we think it's going to be worth $3,200. Salvage value is also sometimes referred to as residual value. We'll take the cost minus salvage value and evenly divide it by the estimated useful life in years. For straight line depreciation, that's measured in years. Keep in mind, we indicate we think it's going to last 5 years. So let's work through this. Cost of $26,000 minus salvage value of $3,200 equally divided by 5 years. That's expected useful life. So that's $22,800. That's the total amount that we're going to depreciate divided by the 5 years. And voila, magically, the amount of depreciation expense that we're going to record each year is $4,560. Every single year in straight line depreciation, we record the exact same amount of depreciation expense. So this is one way to do the calculation. Again, we're going to stay pretty simple in this particular chapter. Now, you don't have to memorize the table that I have here. What I just want to prove out is over the 5 years, again, equal amount of depreciation expense of $4,560. Slowly, the value of the asset on the books, it starts out at cost of $26,000. As we record depreciation each year, slowly over time at the end of the 5 years, magically what should be left on the books is the $3,200. And keep in mind that should agree with the salvage or residual value. Again, you don't have to know all the details of this particular table, just make sure you can actually calculate straight line depreciation and you know it's an equal amount each year of depreciation expense. What you do need to do is one last thing is record the adjusting entry as of December 31st, 2016. So if we go back to we identified this as a prepaid or deferred expense, usually with those types of adjusting entries, we debit some type of an expense account. Again, we noted this is a special category called depreciation expense. We add the equipment on there to mention that it's related to equipment. We're increasing the expense account because we're showing the cost being used up. So we're in a debit depreciation expense equipment for $4,560. Now, typically in these situations, we credit the asset account directly, whether it's supplies, prepaid rent, or prepaid insurance. And we're going to be a little bit different. Instead of crediting the asset account directly, equipment, we're going to credit a contra asset account. Yes, contra asset account, accumulated depreciation, equipment for $4,560. Now I said contra asset account. So when I mention asset, it is related to an asset account. In particular, it's related to the equipment account, but there's a contra added onto that, which means it has opposite the normal balance. So while equipment is going to be increased with a debit, this contra asset account accumulated depreciation is going to be increased with a credit. And that is our journal entry.